All right. Ladies and gentlemen, apologies for the delay of a few minutes. We are privileged to have here with us today Dr. Anne-Marie Gould, Deputy Director, IMF Asia Pacific, Dr. Louis Breuer, Senior Resident Representative, India, Nepal and Bhutan, IMF. Distinguished panelists, we have Mr. Shogata Bhattacharya, Chief Economist, Axis Bank. We have Mr. D.K. Joshi, he's the Chief Economist, S&P CRISIL. Dr. Mridul Sagar, he's the Advisor in Charge and Head of the International Department of the Reserve Bank of India. Dr. Ajit Ranade, he's the Chief Economist of the Aditya Birla Group. And we have as moderator Professor Anant Narayan from the SPJ Institute of Management and Research. The World Economic Outlook, as you all would very well know, is one of the most widely followed flagship publications of the IMF. It's published twice a year. And the report, along with the Regional Economic Outlook, it gives a very detailed analysis of the macroeconomic events and policies that affect growth and the growth trajectory of the world and regional economies. The report also produces near and medium-term projections for key macroeconomic indicators for several countries. The way the program will go today is this. We'll start our program with a welcome address by our MD, Mr. Vikram Limai. Then we'll have a presentation on caught in prolonged uncertainty, challenges and opportunities for Asia by Dr. Anne-Marie Gould and Dr. Breuer. The presentation will then be followed by an India-focused panel discussion, which will essentially look at what are the implications for our country, given the backdrop of the IMF's Regional Economic Outlook. May I now call upon Vikram for his welcome address, please.
Good afternoon, everyone. Dr. Anne-Marie Gould, Dr. Louis Breuer, distinguished panelists. On behalf of NSE, I welcome you all and thank you for your participation. I'm happy to inform you that this is the third event that NSE has organized jointly with the IMF in the last 3 years. The overarching agenda for today's event is to discuss the current macroeconomic scenario and outlook for the world economy and the Indian economy in the context of the World and Regional Economic Outlook publications by the IMF in October. Global growth has fallen over the last year, with the slowdown being most pronounced across emerging and developing economies. In the October release of the WEO report, the IMF has reduced its growth outlook for the world economy to 3% for 2019, the slowest since the 2008 financial crisis. According to the report, the slowdown in global growth is geographically broad-based and the result of a weakness in industrial activity, escalating trade concerns, and rising geopolitical conflicts. Economic growth in India has also fallen to 6-year lows in Q1 FY20, led by weakness in consumption, trade, and investment growth. The IMF has also revised India's growth outlook downwards to 6.1% for 2019. Having said that, I would also like to add here that the IMF in its report expects India's growth to improve to 7% in 2020. Capital markets play an important role in contributing to the growth and development of a country's economy. Capital market activity is an indicator of the overall health of the economy. International and domestic macroeconomic developments have a great bearing on the performance of capital markets. In this context, getting a wider perspective on the current uncertain global macroeconomic environment and its implications will be very helpful. Once again, on behalf of NSE, I welcome you all to this conference and thank you very much for your participation.
Dr. Gould, please, for your presentation. Can you start a presentation?
Slide change.
Yeah. Okay, so good.
Good afternoon and welcome to this briefing on the IMF's Regional Economic Outlook for Asia, which is the flagship report of the Asia Pacific Department. It's developed on the basis of the World Economic Outlook forecast. So what I want to do today is to use the world forecast to provide some context and some outlook as we see Asia's development in the near and medium term. I then want to talk about the risks to the current outlook and the policies that we recommend at the IMF for that. I then, as the introduction said, want to say a few words on the forecast for India to maybe stimulate some of the views that the panelists will give us later. And I want to end with a quick summary of a special study that we have done in the context of our regional outlook, which talks about South Asia as a region and the growth prospect for South Asia. But let me start with the context and the current outlook. So what do we see for global growth? The IMF sees global growth as slowing to 3% for 2019. This is the lowest growth level since the global financial crisis, and it is even significantly lower than what we had only forecast in April of this year. So what are the main reasons for this? The main reason really is a sharp fall in trade and investment in many countries as a reaction to the prevailing significant uncertainty, especially in the context of global trade tensions. And we have seen recently that there was after a brief calm, the trade tensions have re-escalated in August and are expected to be to remain elevated in the near future. So, as a result of that, we had across the board downward revisions in growth, particularly in emerging Asia. So, as a whole, we forecast 5% growth in Asia for 2019. This is a lower growth figure again than what we had in April. For 2020, we only see a marginal pickup of average growth for Asia to 5.1%. This would be the slowest growth for the region since the global financial crisis, and it mirrors the directions that we see, that we also see globally. And what is important is to know that these growth forecasts downgrades cover all major Asian economies. And in some cases, the revisions are quite large. Compared to April forecast, for example, we've downgraded Korea by 0.6 percentage points. Hong Kong, given what's happening there, much more significantly by 2.4 percentage points, but also India, we forecast now 6.1%. We were at 7.3% in April of this year. So very significant recent developments. Let me look at what is driving the growth forecast. This slide looks at the world as a whole, and it looks at developments in investment, import, and real GDP growth. And we see that most of the declines really come from real investment and import volume declines. And if you look at the Asia, at the bar for Asia, we see that on both indicators, but particularly on the import, Asia is more pronounced than practically all other regions of the world. Okay, now against this background, we still should not forget that Asia remains the fastest growing region in the world, and that Asia is the growth engine for the world. It contributed about 2/3 of global growth in the recent years. For 2019, Asia contributed more than 70% of global growth. China accounted for 39%, India 16%, the Asian countries together for 10%, and just as a matter of comparison, 12% of global growth came from the US and 11% from Europe. For next year, we see a slight recovery to global growth to 3.4%. This increase, however, is not driven by Asia. It's mainly driven by a return to growth of some of economies that are currently quite distressed, that are like Russia, Brazil, Turkey, Mexico, Argentina. In Asia, we expect a more differentiated development for next year. We see growth increases in India, ASEAN, Korea, but those will be offset by growth declines in China and Japan. Let me turn to just a few highlights on major countries as we see that. Starting with China. China is expected to grow by 6.1% this year and to slow down to 5.8% in 2020. Now, growth has been revised several times in China downwards, and the main driver for these growth downgrades were the escalating trade tensions, but also the impact of some regulatory tightening, which in principle are needed in the country but have a negative impact on demand. So if you look at the components of these two factors, we see that the decline compared to what we expected last year is 2.3 percentage points between 2019 and 2020. So we estimate that roughly 3/4 of this impact of the trade tensions and regulatory tightening in China, about 3/4 of it are due to the trade conflict and about 1/4 due to economic fundamentals. In terms of the forecast, the overall outcome is less than the 2.3%, and that's because China has taken stimulus measures that would increase demand by about 1.5% of GDP. So cumulatively, the growth forecast has been reduced by 0.8% of GDP from 1 year ago. But before ending on China, I want to make an important point, and that is that the composition of the policy stimulus in China is likely to support domestic consumption. And with domestic consumption support, this is less friendly to, or less likely to cause spillovers to the rest of the world, because there will be less import-driven demand compared to, say, if they had used infrastructure as stimulus measures. Let me turn now to Japan. Now, Japan is the only exception, I would say, from the overall picture, because Japan is expected to grow by 0.9% of GDP this year, which is above potential growth for Japan. This is driven by private consumption and by public spending. But in line with what we see in the global environment, net exports for Japan have been declining. For next year, we see a fairly significant growth decline for Japan. We expect Japan to grow by only 0.5% in 2020, mainly due to weaker private consumption following a recent increase in the consumption tax rate. In addition, we think that the contribution from net exports is expected to remain negative due to the continued adverse external conditions. Finally, a more accommodative monetary stance by other major central banks, together with safe haven inflows into Japan, can complicate the BOJ's reflation efforts and can cause appreciation pressures for the Japanese yen, which then might have, again, dampening effects on exports. Now, let me turn in my overview quickly to where we see India, which I will take up in a little bit more detail later. We expect India to grow actually quite rapidly after the election, but we have seen that growth actually decelerated to 5% in the first quarter of this fiscal year, and that this deceleration has continued through the second quarter. We initially saw that the growth decline was due to corporate and environmental regulatory uncertainty, stresses in the bank and financial sector, and decline in other decline in consumption. We also knew that there were some sector-specific weaknesses, such as in auto and real estate sector. We still believe that growth can gain momentum in the second half of this fiscal year, supported by the lagged effect of monetary easing, by the recent reduction in the corporate income tax rates, and some measures to address the regulatory uncertainty, as well as government programs to support rural consumption. But given the very recent data that show the continued weakness of the economy, I want to emphasize that the risks to the forecast are really at this stage to the downside. Let me now, talking about risks, talk about for Asia as a whole, where we see the risks, the downside risks. A major contribution to the uncertainty and the risk in the global environment and the environment that it sets for Asia is the uncertainty surrounding the China-US trade tensions. We know that tariffs themselves have a negative impact on economic growth. So I don't, in this slide, what we are looking at is not the effect of the tariffs, but it is the effect of the uncertainty that's being created from the somewhat unpredictable trade measures that have been taken. So this is a model-based, look at the impact of an indicator of trade policy uncertainty that my colleagues in research have created. It looks at two scenarios: one, escalation; another one, a truce. Escalation is just measured as a jump in the trade policy uncertainty back to its peak that was observed in 2018-2019. Truce, by contrast, is measured as the drop in trade policy uncertainty that was observed when a potential trade deal was expected in the first quarter of 2019. So if we look under the escalation scenario, so the red bars, we see that the investment to GDP ratio would be about 1.5% to 2% lower over 2 years, and that the corporate spreads would be 35 to 50 basis points higher across China, emerging markets, and advanced Asia. By contrast, under truce, we would see a significant boost to investment and lower spreads. A second uncertainty is on what the trade decisions will do to the dislocation of global value chains and the dislocation of production. This is still somewhat early in the game, and data on this are still emerging. But this slide shows that countries with more sophisticated export products, such as countries that are integrated in more complex supply chains, have been so far more strongly affected than others by exports decline. they've seen negative export growth in most cases. So one interpretation would be that they would be at risk for dislocation in global value chains. Talking about risks, we have to talk about oil prices. Asia as a whole is an oil importer. The current VO forecast is based on the assumption that global oil prices will be around $58 per barrel in 2020. But you all recall that in September of this year, oil prices jumped briefly to $70 per barrel after a drone attack on some Saudi oil fields. This has been reversed, but it illustrates the large uncertainty countries face with respect to oil prices. Of course, there is a slight risk also of the oil price being lower, which would be an upside risk. Let me turn to the continued accommodative financial conditions that, in the first place, will support growth. They will, lead to possibly more capital flows towards Asia, and that should have a positive impact on the economy. However, Asian emerging markets will need to be prepared for sudden tightening of financial conditions and possible capital flow reversals. Why is that so? Market expectations in the US right now, there is a large gap between market expectations and the Fed's outlook. And this creates a potential for sudden shifts in market sentiment, as we have seen in the past also. And this can change financial conditions quite rapidly. A second and related concern is from spillovers from changes in renminbi, the Chinese currency, which have substantial implications for exchange rates in some key Asian emerging markets, especially those with stronger trade links. If we look at this sensitivity, we have seen that over the last 10-15 years it has really markedly increased. So if you look at what the trade tensions already have done, so the renminbi has depreciated by 4% against the US dollar and may depreciate more. So Asian policymakers need to be prepared for sudden volatility in foreign exchange. So let me come to policies that the IMF at this stage would recommend. The overarching priority, and that's really the global overarching priority that we see, is there is a need to reduce policy uncertainty and re-establish multilateral systems. But assuming that this uncertainty stays with us for a particular time, for a certain time, let me go through a list of recommendations that we make in our publication. An overarching point to be made, and I'm sure that will be discussed by the panelists later, is that countries, while there are common trends, countries do differ significantly, so specific policy advice will need to be tailored to country-specific circumstances. So we have countries that have fiscal space, and in those countries, fiscal policy should help smooth demand. But there are other countries where fiscal space is at risk, and I would put India in that group. Rebuilding buffers will be a priority. For monetary policy, we see that monetary policy, where inflation pressures are subdued, should be supportive of growth. Financial sector risks need to be contained, so we need to look at the health of the financial sector. Where necessary, financial sector needs regulation and supervision needs to be adapted to minimize financial vulnerabilities. and where private debt entails potential financial stability risks, we will need to look at policies that adequately support deleveraging and protect the financial industry. Structural priorities become all the more important when they have an impact, and even an immediate impact on growth, as I will argue in a little bit on India. So key structural policies that we are talking about in our regional economic outlook is on labor supply. That relates very much also to advanced Asian countries, where we see a need to promote labor force participation, including where there's constraints to look at higher labor force participation of women and the elderly. Infrastructure, we need to have adequate infrastructure for growth, and depending on where the bottlenecks are, infrastructure needs to be revamped. Regulatory frameworks need to be adapted, and regulatory bottlenecks need to be avoided. And in many Asian countries, there is a need to open the service sector to private investment. And then very important, including for India, with the recent experience that we have experienced in Delhi, there is a need to reduce greenhouse gas emissions, and a need to build buffers to meet the growing incidence of natural disasters. So let me just say a few words on India, and I want to stress that we have done an analysis of the Indian economy. We will have a board meeting of the IMF on November 25, and the full report on India will be hopefully published after that. So this is a preview of some of the data that have already been used for the World Economic Outlook, but it does not have all the details on India. So this is a slide that you have already seen, talking about our growth forecast. So let me just recall that growth has decelerated to 5% in the first half of this fiscal year, and that we see further downward trend at this stage. And analyzing what is actually what actually happens, there is a somewhat different story from the aggregate story that we have seen in Asia. There was a small decline in growth, in imports, as you can see in this slide on the right-hand side, but it was the import growth. Negative import growth was significantly lower than for other emerging markets. So it's not the impact necessarily or not in the first place the impact of the trade tension that has limited India's growth, but what has happened, the global environment has affected financial and confidence has operated through financial and confidence challenge. The decline in trade is much more effect of lacking global demand. So the trade wars, while important, India is somewhat isolated given the low trade share that we see India India has. So what does the IMF think India's policy priorities are? We see structural challenges, and we see a weak cyclical position. So we need to look at policies that address both the cyclical weakness, that would also address the structural challenges going forward. So the priorities that we see at this stage are the following. we see a need for a credible fiscal consolidation that's more ambitious than what is currently envisaged by the government, a fiscal consolidation that will help reduce the relatively high level of debt and frees up financial resources for the private sector for investment. Monetary policy should be calibrated to support the recovery. On banks, we think both governance and efficiency of credit allocation need to be examined, and we would in particular here point to the need to improve the governance and credit allocation in public sector banks. Then when we're coming to structural reform priorities, I mean, they have a whole area in terms of labor, land, product market reforms that would be needed to enhance competition and governance. This needs to be coupled with appropriate infrastructure investment to create jobs for India's young and growing labor force. So with this overview, let me go briefly through a small number of policies, starting with fiscal policy. As I had already mentioned, and as we see on the right-hand side slide, India's public debt is comparatively higher than most other emerging markets. We therefore see no room for Indian fiscal policy in India to provide significant stimulus. The recent reduction in the corporate income tax rates was appropriate. It will contribute to the recovery in the short term because it has brought corporate tax rates more in line with the rates in competitor countries. But so far little has been done to offset the revenue impact, and we feel that the revenues impact needs to be considered going forward and compensated for. So if with no room for fiscal, the growth impetus has to come from other places. Another brief slide on fiscal issues. The left-hand slide shows how often fiscal targets have slipped over the past. So we would urge that fiscal policy be formulated against more realistic background to give a more clear direction and give a more clear framework to private sector expectations. At the same time, more realistic fiscal transparency. Fiscal transparency should also be increased. I mean, it's fairly difficult for the private sector to get the full picture on fiscal standing. In this context, India is somewhat lagging in a program, the G20 Data Initiative on Fiscal Transparency, where comparator countries have all made greater progress than India. On monetary policy, headline inflation is currently below the midpoint of the RBI band. With a negative output gap, inflation contained, and subdued global growth, we see that the recent easings, 135 basis points altogether, have been appropriate, and we see that on balance that monetary policy should continue having an easing bias until at least the projected recovery takes hold. On the banking sector, the efforts that have already been taken to tackle some of the legacy problems are welcome. So some capital injections have taken place. There have been some efforts to resolve non-performing assets and strengthen capital positions, and those should be continued. I think the most pressing needs, in addition to those measures, are to improve governance and efficiency, especially among the public sector banks. In this regard, we're also calling on the Indian authorities to implement the recent announcement of the public sector, of the merger of public sector bank in a cautious way that would enhance the efficiency of the new entities. Smaller financial institutions, again, it's an area that has where some policy actions have been taken, but there were some highly visible problems in smaller institutions. They were all not systemically important, but what they have shown is that they have created some negative perceptions and some problems with credibility that are difficult to deal with, and that have had negative impact on expectations and could have more of an impact than actually would be warranted. So to avoid further spillovers, very clear action is needed, and actions that have been initiated to differentiate between those institutions are welcome and need to be continued to be kept in focus. So, as my final slide on India, I want to talk about some key structural issues. As you all know, and as you can see, structural measures are key to long-term growth in the economy, and this is mainly, or to a large extent, because the overarching importance of creating jobs over the next, the UN predicts that over the next 10 years about 130 million more Indians will enter the labor market. So structures need to be created that would allow for the absorption of this labor force. We have in our forthcoming report more detailed views on infrastructure investment and a set of product market that would improve the business climate, that help trade and investment liberalization, and importantly address some of the agricultural sector reforms that will be crucial to essentially release the labor from the agricultural sector. With also an overarching need to expand the manufacturing sector. In India, the manufacturing sector, compared to many other emerging markets, has not been the driver of growth, and we certainly see that India has been very successful with a service-led growth that should continue. However, new manufacturing production could create the necessary amount of jobs that would be needed for people who will not be able to be employed in high value-added services. The expansion could come from upgrades within the existing baskets, or from new fields in which India could move into. And it should, as I said, manufacturing should complement and certainly not supplement the service-led model that you have. Before closing, let me just say a very few words about the study, as I mentioned, on South Asia. The main author of this study, Ms. Manuela Goretti, is sitting here in the first place. If over tea later on you have some questions. South Asia, for us, looks at 6 countries. So essentially India, Bangladesh, Nepal, Bhutan, the Maldives, and Sri Lanka. And we are looking at what is needed for this region together to continue the quite substantial growth rate that they have been seeing over the last decades, where growth rates have reached 7 to 8%, and where globally 200 million of people have been lifted out of extreme poverty, and life expectancy has risen by more than a decade. So this is a very interesting region, and definitely something that is worth studying. So to mirror some of what I've said about India, the region as a whole needs to look high-quality, job-rich growth to support its large and rising labor force. As I said, the increase in labor force will be 130 million in India alone. For the region, it will be 152 million. And just to put this in perspective, I mean, this is the entire population of Russia or Mexico, and all of these people will be coming into the labor force in this region within 10 years, a span of 10 years. So in our study, which is online in all its detail, we emphasize that 3 areas need to be taken into account, need to be addressed. The first is policy space for reform, which looks at the macroeconomic policy environment, which is a necessary requirement. So all of these economies need to have stable macroeconomies. They need to take measures to support private sector entrepreneurship. This needs to look at in each country on what the bottlenecks are, but all of them need to grow, and all of them need to give the private sector a dynamic role. And another common factor in all of those countries is a need to invest in people, to have broad education, where some countries like India already have world-class tertiary education, but all of them need to improve primary and secondary education, and need to get more people into the workforce. We have in our paper modeled what could be if we take all these reforms. So given the complications of modeling some of the countries that are smaller, the model results here are based on Indian data, and we have the baseline version and the reform version. The reform would in addition to what baseline assumptions are included in the VO, would look at the set of reforms that I talked about. And I think an interesting figure for people here in the audience in India is that our model shows that with the right kind of reforms, by 2040, India could reach 50% of the per capita income of the US. So I think this is something that would be a sign that that reforms can pay off. I think with this I would like to close. I thank you very much for your attention, and I really look forward to hearing from the India experts on what we did not look at and where the IMF should improve their analysis. Thank you very much.
Thanks a lot, Dr. Gould. Before we go on to the panel, may I call upon Mr. Ravichandran, our President, to felicitate our IMF dignitaries, please. Sir. Dr. Anne Marie Gould, please. So this is for the silver jubilee of our. Dr. Broer? No, one more. One more. One more. Dr. Louis Broer, please. Thank you, sir. Thank you. May I now call upon the panel to be on stage? Anant, DK, Mridul, Ajit, Shogata. Pardon me? Coffee? I'll get them. So they keep saying this panel needs no introduction, so this time I'll actually refrain from introducing. Anant, all yours.
Thanks, thanks Tirthankar, and especially for not introducing us. That's very useful. Thanks Tirthankar and the NSE. I see board members here as well. Thanks Dr. Gold for an excellent presentation, and thank you all for being here. Doesn't require an introduction. We actually have 4.5 economists here. I'm the half pretend economist sitting in the middle. And the beauty is you also have economists who are representing different parts of the world, right? So you have a banker, you have a rating agency, you have the regulator in RBI, and you have industry. So whoever you want to beat up, whichever section of stakeholders you want to beat up, they're all available here, one shot. What we'll do is, before we get into the quick panel, we have a pretty knowledgeable crowd here. All of you track markets, you track the economy. You don't require introduction, many of you yourself. So let's do a quick show of hands on to gauge the mood on how we feel right now. Okay, so a few questions to start with. What do you think about the state of the economy in India currently, as things stand? So 3 choices. It's terrible, B, it's neutral, and B, it's excellent. I'm not giving you in between, 1.5 kind of things. Let's go extreme, right? So terrible, neutral, excellent. So let's start with excellent. Yeah, at least one half hands. There might be a CCTV here somewhere. Okay, neutral.
Okay, good.
8, 9, 10, 11, 12, 12.5. Terrible. Wow. Okay.
I think this is a implication.
This will be asked separately anyway. You won't be let aside, right? Okay, so second part is what our outlook for the future is. Okay, how are things going to look like, let's say over the next year and a half. So let's take a bit of a time frame here. So the 3 choices again. 3 choices is it will pretty much be the same as we are right now, not much of change expected. Second is it will get worse before it gets better. I'm going to keep it gets better as a final destination. Third is it gets better. Okay, so stays where it is, gets worse, gets better from where we are right now. What happens first? So what do you think, how many of you think it stays here for next 18 months? Not much of change. Okay, how many of you think it gets better? Yay. How many of you think it gets worse? Same. Last one, and then we'll let you go back to sleep. Equity markets. NSE, we are in the house of NSE, so let's take a look at the Nifty. Nifty is almost what, 12,000 today? Let's be generous and say it's 12,000, it's not 12,000. 5 choices on where Nifty will be 1 year from now when IMF come back to make the next presentation, right? So the choices are the following. If it's 12,000, then 11,750 versus to 12,250, so 500 point range. Then 11,000 to 11,750, below 11,000. So that's the downside. On the upside, you have 12,250 to 13,000 and beyond 13,000. You got that? So 5 ranges in all. So let's start from down all the way up. So 1 year down the road, below 11,000. All bulls. Oh, one. Arvind is here. Okay. Between 11,000 and 11,750. Okay. 11,750 to 12,250. Okay. 12,250 to 13,000. I think the bulls have it, right? Beyond 13,000. Great. Okay. So Mixed, but I think more on the bullish side as far as the markets are concerned, less bullish when it comes to the economy, I thought. Okay, we leave the market question out because I don't think we'll get them talking about where the Sensex is headed or the Nifty is headed. But let's get a sense from each of the panelists here on how you feel about the economy as things stand right now. Where do you think it heads from here? And let's try and give a number. Where do you think GDP growth will be for FY19 and FY20? Who wants to start? Shogato, why don't you start?
So first, thanks so much for having me here. I mean, it's a huge privilege. GDP growth, as you said, numbers 5.7 to 5.9 this year. Continual shaving off of growth. So this and 6.3 to 6.5. Fingers crossed for next year, FY20. Amongst the camp, that I think the situation is likely to remain relatively slow for the time being. The H2, normal H2 climb out is, we don't see very much of the H2 climb out that we normally see. Growth will be better. I mean, for crying out loud, I mean, everybody is trying. The Reserve Bank is trying, the government is trying. There has to be some traction somewhere. So, some improvement, but not too much.
Okay, thanks Shogato.
Yeah, we are yet to revise our numbers, but as of today, we stand at 6.3 for this fiscal year, which is risks are tilted to the downside. We're waiting for the second quarter GDP to see the number, how much below 5% it is. And then I think that will also tell us what the momentum is. Then you can, rather than revise it every now and then, so we'll just take a call after the second quarter number is out. For next year, we are at 7%, and I think there is, as Shogat was saying, the recovery is going to be gradual because the monetary policy has a lagged impact, and the monetary policy in general, the transmission is weak, and I think there's risk aversion in the banking sector. So even if there is transmission, whether credit will be given is a different issue. So that's one, and then I think fiscal policy is not being deployed aggressively to push growth up, and I think what's most important is the financial sector. This downturn is somewhat different from the 2-3 downturns that we have seen in the past, because this is accompanied by cleanup in the financial sector, which first happened, I think, before this was in mid-90s to late 90s. I think so. This makes the recovery protected and very difficult to predict also. So the stress in the financial sector and the weakness in the real sector are right now feeding into each other in pulling the economy down. And I think we think that by the fourth quarter of this year, things will start looking materially better. I mean, that's our current forecast.
Great, thanks DK. A lot of the issues you brought up, we'll pick up separately, including the fiscal part, etc. RBI. Sorry, you're Mridul, you're at RBI.
Yeah.
So let's start with...
If you constrain me with the RBI, then I'll say wait for the MPC to
This is Chatham House, right? So we won't go tackling outside.
So purely, personally speaking, I'm with DK in many senses. I mean, clearly we have had growth plummeting for some time now, even whatever information which is coming in terms of the industrial production or in terms of the core of that segment has not been very encouraging. But clearly the other part is that there has been a front-loaded policy action, and that's something which the market should probably need to recognize, because at the moment its impact is minimal. It's seen more in terms of asset prices than in terms of real economy. But what has been done in terms of policy action has been huge, and this needs to be recognized that almost a 10% decline in effective corporate tax rate has to have had some effect on the arresting the corporate profitability downturn, improving the cash flows, probably have investment cycle kicking in at some point, which is at the present pretty low. So a lot of it, what our moderator has been telling is that it's essentially a trust deficit. And I think the trust deficit will get slowly addressed given what is happening on the ground. And the revival should then set in. 4Q should be definitely better. In fact, the base effects are favorable in the second half, but I'm not looking at base effects. I'm also sort of bringing in the fact that growth in the first half had some one-offs in terms of a bad winter crop, and monsoon has been reasonably good. The spatial and temporal distribution was an issue, so maybe not that much in kharif crop, but the winter crop prospects look bright with reservoir levels at almost 20% above the long-term average. So hopefully the base case should be that the growth should start looking better. Whether it reaches the sort of 7% expected in the second half in terms of the forecasts available officially is to be seen. The risks, I would agree, are sort of tilted on the downside, what the fund was saying. But in essence, I don't think there is a case for gloom, because clearly the second half would be better than first half. And as we go into the next year, I think there is we should see credit growth improving. Part of the market freeze we are seeing at the moment should go away, and the revival should then set in on a more stable basis.
Great. You have a number for the second year for FY21?
Officially, we only have a number for Q1.
Unofficially, your middle number.
So I would hesitate to put the number, because the range of uncertainty is large. At the moment, even the global growth, how it might impact, because see, if you see the net export component, it's not very significant for the Indian economy. But as was being said, the confidence channel is playing a very big role here. And it will not depend on whether, say, at the APEC a trade deal is seized. Similar trade deals are seized elsewhere, including that by India. So these are some of the uncertainties which still prevail in the policy front. And I think we need to work on reducing those uncertainties and get the growth improving globally as well as in India.
Spoken like a true central banker. Ajit, you have the last word on this.
So below 6 this year, above 6 next year. What a forecast.
As succinct as you can get. I won't let you get away with that. Let's start with Dr. Gold's excellent presentation, where she painted the picture of, as IMF sees the region, the world, all of that. Before we get into the specifics of what she discussed, how much of, clearly the mood as far as the economy was concerned in this crowd, and I guess it's true outside as well, is the mood about the Indian economy isn't too great. How much of the problems that we see within our country right now are linked to external sector, and how much is of our own domestic idiosyncratic issues? Ajit, let's start with you this time.
No, it's true that I think she said almost everywhere the revisions are downwards. I saw this string of negative numbers across the row. So incidentally, that's supposed to now become a specialty of the IMF, that it doesn't start in November, it usually starts in January. And by the time you come to the last revision, they're always downwards, except for 1 year in the last 6 years. So we got used to IMF always revising downwards. But it's true, it's globally everything is being revised downwards. So to that extent, it's global. But I don't know how much of India's problems are because things are getting revised downwards globally. So I don't think there is a strong connection that way. I mean, clearly here, domestic consumption, which usually is very, very persistent. I mean, the growth in the drop in consumption is the growth rate of consumption doesn't start dropping that easily. So that's usually very persistent. So that also is slowing down. India is a consumption, sort of largely consumption driven. So that's clearly a domestic story. Then private investment has been sluggish for a very long time. Capital formation has been either stagnant or going down. So a lot of it is domestic.
So I hear you saying it's predominantly domestic rather than...
A large part of the slowdown is domestic, yes.
Right. Would you agree with that, Mridul?
Yes, I would agree. Largely domestic factors have predominated. But I think it's important what I said just now, that the confidence channel has played a very important role in this whole game. And that is where the global factors get magnified by a multiplier, actually, than what one would otherwise see. It works through the financial channel essentially because confidence loss is huge. But just on what Ajit said, like, it's true there may be systematic bias in VO estimates which get revised downward. But what is also significant is that the Conference Board has also sort of ratified the VO number by and large. And they see the growth stabilizing around the long-term trend in terms of the global growth, which should be just under 3%. So it's not that bad a scenario as it looks. And maybe a month back it looked like in absence of trade deals. But I think a lot would now become contingent on how the trade deals get done.
But a global growth below 3 is actually technically recessionary.
Almost recessionary in many ways, I agree. Anything that...
I would beg to differ on this. I think this is where lack of understanding is coming, there's anchoring on the growth coming from the pre-global crisis levels, which was very high.
Right.
So if you see 2010 to or 2000 to 2007 period, where you grew at 4+ in stuff, that was a credit bubble in essence, which has prompted global growth to go very high. And I was surprised that the view sometime back, I think in 2016, sort of said global growth is too low for too long. The truth of the matter is, if you do a long-term trend analysis, the global growth had already recovered to above the trend. So we must not lose sight of the actual fact of the history. And I think it's wrong to expect global growth to be as high as 4%. We should be happy at 3% around.
That's a fair point. That's a good thing of having 4.5 economists. You'll get 6.5 views. And you know the two laws of economists, right? So for every economist, there's an equal and opposite economist. And both of them are wrong. So, anything you want to say which is different from what they've said as far as...
Just wanted to add a bit that I think many things have been unfavorable, but the idiosyncratic factors have played out very favorably for India. Oil, which was expected to be higher than this, I think this is a blessing. And we all know how it impacts the economy, whether it is growth, inflation, or current account deficit. Apart from that, I think monsoons have been in some sense better than better than expected, because the groundwater situation is pretty good and the next season is likely to be pretty strong. I think that among the domestic factors, what I would say is that some of the reforms that created headwinds could have been designed better. So that was something which we could have controlled. I mean, we could have had a better GST, a better implementation. I think that created quite a bit of headwind.
Fair point. DK, I hear you saying that actually global factors have been favorable for us. And
well,
we've done things so wrong that domestic factors actually negate for that.
If you look at the advanced countries, I mean, they're probably growing above their trend right now, even today. I mean, if you look at US, Europe, I mean, so there's no big drag coming from there. And actually, easing of financial conditions have meant that money has flowed to emerging markets, and it has helped us. So I think the stress is coming from the trade side, the uncertainty premium that the trade war has created. I think that is causing downturn in investments in some of the economies, and to which we also export. So that, in that sense, indirectly, I think it is hitting. I'm not saying it's not hitting us. It is hitting us.
So can I just add to that? So oil prices moderate, monsoon very good, current account deficit very modest, foreign exchange reserves all-time high, inflation very good. We should just stop here.
Would you stop there?
The macro story.
So very, very quickly, I think 3 points to this. So one, many of you would have noted, and we were talking about this, that the IMF markdown of India's growth from the July number to the October number was 0.9%, 90 basis points, right? I mean, that's far, far more than all the others. I mean, 0.2, 0.1, Latin America 0.4. So that seems to indicate to me that there are more domestic factors at work. The IMF had not anticipated the domestic factors at play. Having said this, number two, the face of the slowdown was the auto sector. And in the auto sectors, particularly for cars, I think exports have not done anywhere close to as badly as domestic sales. So exports in automobiles has actually been positive. For commercial vehicles, it's been negative, but much less than exports are anyway. The key part to note is that the slowdown happened in the Q1 from 5.8 in Q4 to 5%, which was what caught our attention, which made us focus on the slowdown, happened almost entirely from manufacturing. And in manufacturing, if you see the manufacturing growth slowdown, the GDP manufacturing growth slowdown, from 6.9% in FY19 to 5.9% to 0.6% in Q1. Exports had come down from 9.2%, manufacturing exports had come down from 9.2% to minus 2%. So which is the contrarian. So you don't need three economists. Even within the economists, single economists, you might have different viewpoints. So that does tend to indicate to me that there is a fairly large global component in the domestic slowdown as well.
And so where do you stand finally?
Both sides, but as you saw, exports are not a very large part of the India's economy. Sure. So pretty much, I think the basic problem is the confidence, which is showing up in the RBI confidence surveys. But if Yeah, but if that's the case, then we are in for a long haul soon.
So very quick one on consumption. I think we've been talking about how consumption has fallen. I think just to refresh the memory, in 12-13, private consumption had fallen by -1% in one of the quarters. So it's very volatile. I think we should remember. I think it's a residual. So I think the 3.1 is not going to stay 3.1. It's going to move up. I think that's one. And I think in one of the years when we got fiscal years, we got 7.4% growth. In one quarter, private consumption growth was 2.1%. So I think just trying to bring that, it is also some sort of an idiosyncrasy is there in private consumption. Because it's a residual. I mean, that's how it is estimated in quarterly growth.
Fine.
I'd just like to pick on what Sugata was saying. I mean, it's absolutely true. Otto sort of led the thing. Globally, it's led like that. It's starting with Germany in particular. And we must understand that there are, while there is a genuine slowdown component to it, the numbers got magnified because of certain creative disruptions which were introduced through environmental reform sort. I mean, clearly India chose to move from BS4 to BS6, leap jump, and that has created an uncertainty where people are not able to sort of necessarily buy the stuff. There have been sort of security measures in terms of airbags, stuff, which has sort of magnified this. So let us, the other angle was that the NBFC lending, there was a crunch, and that sort of also affected the sales. Now, the essential call is it going to be long-term structural, or is this cycle going to play out? And I do feel that even if it's not a V-shaped recovery, we could clearly see a sort of a U-shaped recovery setting in.
So we'll come to that, Mridul, because the point about the fisc space being limited, I think deserves as a proper discussion by itself. The last bit on the external sector, and I'm going to start again with you, Ajit. Two related issues, or maybe they're not related. One is India has just said no to our CEP. Second is we've chatted for a long time about how movement of supply chains out of China should be an opportunity for us going forward, just as it is for Vietnam and Bangladesh and Brazil and Korea and a whole bunch of countries. How do you read India's no to our CEP? And second, how do you think we are doing or can do or will do?
I don't think I very much like to think that we have not said no to RCEP. Right. It's the treaty is going to be signed, I think, February or March 2020. So we still have a few more months. Right. And we even today the official line is that if our issues get addressed, then we are ready to sign. So I'm hoping. I think it's just that we are hoping to get some more leverage on the negotiations. Although we've lost some advantage because you can't say no on a public speech. But I think we should not be walking away from RCEP. And it's very true that we have a look east and act east policy. This is a part of the world where you have half the population and 40% of the GDP and trade coming. And this is the fastest growing part of the world. And it's going to grow. So the center of gravity is shifting to the east anyway. So we can't be doing a Brexit out of our East Asia before even joining them. So I hope this is just a temporary thing. And yeah, value chain is very important, but the value chain argument is exactly opposite of what we have been doing. So it's a very big shift for us. We have been saying that unless you have 35% value addition from a country, rules of origin, that's when we will allow a free trade agreement. But a value chain, global value chain argument is that even if it's a 1% value addition, so long as you're part of the GVC and it's creating employment, you should actively embrace GVCs. So for us to actually switch over to the GVC philosophy is a major shift. I think it's the right philosophy because it's employment intensive, but then in light of Industry 4.0 and automation and all that, so it's a little bit of a complicated question. But on balance, I think we should switch to the GVC philosophy. And there's a big opportunity coming from stuff moving out of China. Trade war or no trade war, it's going to move out of China anyway.
So maybe we keep the China's supply chain slightly separate and stick to the RCP part. If I hear you right, you're saying we should be signing the RCP hopefully?
Yes.
And you're plumbing for that?
Yes.
Would you all agree with that? You think RCP is something we should be joining?
I think it's music to my ear because all I was hearing from the industrial group was that we should not be signing RCP.
No, sorry, sir, that's Amul.
Sorry. No. So in essence, I think what is missing in this debate is there has been very little talk of what RCP will do to consumer welfare. I mean, you can't take trade policy decision just on the basis of what its impact is on industry.
Sure.
You have to have calculations for consumer welfare. And I'm sure the government is taking a more holistic view, and this is not the final decision. It has to be arrived at very carefully, and that's what they are doing. So it's not the final word what you may have heard. Obviously, it would require some quid pro quos, and I mean, given the market access what India gives, has to have some benefits to India. I think there is a fair case that certain more negotiations on RCP have to be done, and India's decision would be contingent thereon.
So the left of center, left of my center is taking a very right of center view. Does the right of center take a left of center view? Do you guys agree with this? Should we be joining the RCP?
Well, I think we need to buy more time to make sure that we don't get
somebody plumbing for the industry. Go for it.
No, not, I mean, see, the point is you are running a massive trade deficit with RCEP countries. Your previous experience with FTAs has been you've lost out. I'm just looking for one example where we've won. So basically it boils down to being competitive. We have become competitive vis-a-vis taxes now. I think our tax rates are as good as any of our peers. So that is fine. But look at the other parts. Where do we stand as far as competitiveness is concerned? Whether you look at logistics, infrastructure, how will you compete? I simply can't understand. So I'm not saying that we shouldn't do it, but the point is that it has the possibility of hitting us also, I think.
But you
particularly doing this.
You can't compete because your domestic is handicapped. But then you have to fix the domestic.
Yeah, that's beside
that. That's the reform you need. But unless you have a gun to the head of RCEP, you're not going to do it because you've been given 20 years. 14 countries out of 16 are not afraid of China.
So again, as usual, I'm arguing by numbers. RCEP means industry. Industry means China, right? So we are going to get flooded with Chinese goods. As you said, good for consumers, but industry might be in trouble. Now, one data point. China's steel production, and China means steel, right? China's domestic steel output in 2015 was 820 million tons. Their exports was 120 million tons. In 2019, their production was 960 million tons. Their exports was less than 80 million tons. So far from flooding global steel markets, they're actually pushing more towards domestic. I realize there's a problem, but keep it in perspective. Second, I think it's not industry. I think India has been, all the RCEP countries are trying to block India's services trade. Yeah, I think that's the basic problem. Yeah. They're just not willing to accept India's conditions on services. Yeah. Until you actually get a reciprocity on services to the markets that you're opening up, frankly, at this point in time, you're just not competitive with. Look at the ASEAN countries. Myanmar, Cambodia, all of them don't seem to have a problem with ASEAN, with RCEP. It's only we have a problem. So that's I think, services has to offset.
Services, Saugata is a big word. For us, all that it means is software. Why our software companies not tapped into Cambodia, Vietnam, and Myanmar? Why is Infosys only focused on US? The H-1B visas in the US. How much are the software companies of India to be blamed for not developing this side of the world? So, when we keep saying services, actually we basically mean only services. By the way, if you really want to export services, it should be tourism. 100 million Chinese go out of China every year. Not even 0.01% come to India. So where is the tourism export?
That will argue with Infosys and the others, but services. So that I think is the critical part for India to be focusing on.
Fair. Tourism export. So that's here, domestic again. You can't get a license to start a hotel.
That's a topic for the next panel discussion then. But let's take the adjunct to this, which is this point about, and I think Dr. Gul mentioned this as well, supply chains moving out of China. At the moment, in fact, there's a Nomura report which shows that of the 60-odd companies that she's tracked, hardly 2 or 3 have actually looked at India. Everybody else is going to Vietnam, to Thailand, to Malaysia, even Brazil, but not really to India. What gives... are we going to get our act right? Is it still something that we will tap, or do we have to wait for the land and labor reforms, which hopefully my grandchild will see?
Land, labor. Indians being Indians. Land is a problem. Land is a problem because you're seeing project after project after project with huge amounts of potential FDI and debt investments coming in, being stymied by land. I mean, whether it's Maharashtra, whether it be other parts of the Andhra Pradesh, Karnataka, I mean, project after project is getting stuck. Labor, Indians have managed to get across. I mean, it's still a suboptimal thing. Ideally, we should, but the government is moving. I mean, pulling together the multiple labor codes into the 4-code system, we are moving. I think one of the things, and this is the area that I think we are consistently lagging behind on the ease of doing business, is judicial reforms. Resolution and enforcement is something that we need to focus on. This is a soft area, not even a hard area. I think this can be done using big data analytics, etc. I think that's one area that we need to be focusing on.
Do you see that happening? Do you see us waking up in time to say 2 years later, 3 years later, that here is supply chains which have come to India and we've benefited from the whole thing?
I think it is happening. You're already seeing, I think what the government now needs to do is to focus on the large companies. We have been trying to get smaller bits and pieces in, which is creating trouble in terms of the input chains. I think we need to remember that one of the segments that is doing very well now, even now, is the commercial real estate. And that is coming in from a whole bunch of MNCs coming in to tap India's expertise in design, in research, etc. So these companies that were already in India had started to become comfortable with India. So now if you get a Apple or a Samsung or one of the large companies, in a very short span of time, given the move ahead, I think these companies will become comfortable with India, and that's where the services fund is likely to start.
DK?
You see, as I said, we have two advantages. One is the size of the market, and the second is we have become very competitive as far as taxation is concerned. I think the marginal tax is 15%, I think, for fresh investment.
Yeah.
I think it's rest of the hardware that needs to be fixed. I think without that, they'll just not walk in. I mean, just because I think India is a big market and the taxes are favorable. I think vis-a-vis other economies where we stand, I think that needs to be fixed. But I'm pretty sure that we will start getting more FDI. FDI has been strong despite I think economy slowing. FDI has remained reasonably strong. It's coming to services. Unfortunately, it's not coming to manufacturing. That's a different matter. Yeah. I think Amazon, Flipkarts are attracting that. But I would see it as an opportunity right now. But I think the progress is a little slow from our side on that.
I think Sugathar raised a very important point on the resolution. I think that's one area. Having addressed the resolution for the non-financial sector, we now need to move towards
financial
a
sector.
legal framework for resolution of the financial sector.
Yeah.
And if we cross that bridge, I think it will make a sea difference.
In fact, there's a whole talk about extending IBC to NBFCs and the NCLT process to NBFCs, etc., which is, I guess, part of the same process. I've read your articles, Ajit. You've written in the past about opening up not export zones, but special economic zones where you allow free manufacturing, less labor and land restrictions, and so on and so forth. We keep talking about these things, including things like judicial reforms, contract enforcement, but the same thing gets repeated every year ad nauseum. Do you see light at the end of the tunnel? Do you see us grabbing this opportunity?
Yeah, I think, we have had SEZ legislation since 2004, I think, so 15 years, and it's done very badly. It's just ended up being a real estate play. So what we didn't do, I guess now the new stuff we need to do is clustering. So for example, textile is a huge opportunity, but you can't have fiber manufactured, let's say, in Andhra Pradesh, and the yarn is say, Bangalore, and then the fabric making is in Orissa or something. So by the time you move things around, fiber to yarn to fabric to garments to the final destination, you wasted 17% of your cost in logistics. So logistics is a very big part of India's competitive disadvantage. So cluster approach. So cluster means large lands, and clusters have to be around ports. So fiber to fashion, right from fiber to Zara, everything should be in one place, which is the Chinese model, which is very. So that's what I think. Not just in textile, there's also value addition in, let's say, oil seeds, agro processing. So I know that there's a huge export potential. So agriculture tends to be the thing most neglected. So we have not deregulated agricultural exports. India has an advantage in software, no doubt, but we also have an advantage in agriculture exports. Textile exports used to be 24% of our manufacturing exports. 24 down to 12 now. And what is our number one manufacturing exports? Number one, 20% of all our exports is just one item. What is that?
It's oil.
It's petrol and diesel.
Yeah, petroleum products, 50%.
And you know, it's like 8 or 9% value addition. Crude oil comes from the Middle East, we refine it, and 20% of our exports is just oil. And we are not an oil superpower. So textile has come down from 24 to 12. Agro-processing is also vanishing. So these are the kind of opportunities, I think. And not to forget that really services exports is all about paramedical, nursing, education. Why can't India be exporting teachers? And so there's a lot of domestic reform agenda. You can, for a medical college, if you have admission to 50 medical students, MBBS, you get permission only to have 5 nursing students. The ratio should be ulta. It should be for every one doctor, you need to have 25 nurses.
So one on that services
So nursing
bit,
colleges in India.
So services bit, what has emerged as a problematic aspect is these non-tariff barriers. So services requires visas. And visas, although there are initial, in the trade agreements, visa, we will give you a visa, but I mean, you apply for a visa and you wait for 12 months, 6 months, whatever.
So
these non-tariff barriers need to
in
be...
the era of Brexit and President Trump, you know, immigration is a big issue. They're not going to welcome your nurses and teachers like that, because the problem is that the guy who's going to provide services export, to deliver services, is going to stand in the same line as getting a visa for immigrant. So you're going to be treated like a potential immigrant. So this is exactly, so let's not bet on, but there are services which don't require you to go there. For example, software. So a lot of domestic reform agenda remains to be tackled before we even talk about...
So that's a good segue to my next segment, which is going to talk about the fisc and the fiscal space. But before that, you have to choose between 2 areas that you would concentrate on if you were the finance minister. And you can't say both. So either you choose reforms, structural reforms, which is land, labor, cluster, manufacturing, judicial reforms, or you say monetary and fiscal levers to be used. What do you think should be the focus right now to start with? You have to choose one of them. Reforms versus fiscal/monetary pump running.
I think it's a no-brainer. I mean, you know, given the sorry state of affairs.
Don't be sure about yourself.
So sorry state of affairs. It has to be a demand. I mean, both supply and demand. Supply is already coming in. But it has to be a demand. But the problem is, again, I mean.
So by demand you mean monetary and fiscal levers.
Well, monetary is. I mean, you cannot do too much more on monetary. We are almost at the zero interest rate for India. We are almost at the zero interest rate. ZIRP. So, I mean, it has to be a fiscal and monetary policy, as we have seen. I mean, it's complicated. Transmission is complicated. I mean, let's stop at that. But the fisc, even the problem with the fisc is, where do you get the money for the fisc? So, suppose even magically, I mean, you know, we saw the constraints of the fisc. Even if you get the money somehow magically, I mean, you know, foreign investors come in and pile into our bonds. How are you going to spend it? I mean, you know, we hear, I mean, give more money to the rural areas because rural demand is a problem. All of us, I mean, you know, we need personal income taxes, we need more incomes. So should we do that? If you ask industry, they will say there are 7 to 8 lakh crores, 7 to 8 trillion rupees that are stuck with the governments in the budget. So does that need to be cleared? So how do you design that? I mean, you know, so even if you use somehow...
So we'll come to all that, but if I hear you right, you're saying monetary fiscal levers.
Yes, please. Absolutely.
DK.
Yeah, I would agree. I mean, but if you are using the fiscal lever, I think then what you were ruling out, I think you have to be extremely aggressive with reforms so that it just gives a very positive signal that actually country is moving in a different direction.
I think the absolutely truistic answer is that you need both. But I'm asking for the preference or the emphasis, and I hear you say monetary and fiscal levers.
I mean, I would tilt more towards the monetary lever because the conditions are more favorable for that.
Fiscal lever, monetary lever, but levers nevertheless. Sorry, not RBI.
The answer is straightforward. I think it has to be structural reforms to lead the pack. You have to come out of this low growth scenario. The space for monetary as well as fiscal policy is limited. There is some monetary policy space, but as I was discussing with Dan Murray this morning, the point I was making to her was that in essence, when you are giving monetary stimulus, you also have to be mindful of its implications for financial stability in particular. And given that the corporate balance sheets are leveraged, there is stress, so one has to be a wee bit cautious on not worsening the situation further. And for that, it's very important that structural reforms lead the pack. Monetary policy cannot be the only game in the town. Monetary policy can do some things, Fiscal space is also, to my mind, limited. So already you have seen the front-loaded action of 10 percentage point cut in effective corporate tax rates. That sorts of limits for provisions for further action, though the government is obviously trying to do its best under the circumstances. So I think we need to focus on rejigging bit of the fist to generate a wee bit more fiscal space, and that depends how you do the quality of fiscal spending. You need to improve fiscal multipliers in the short run spending.
Which I think is the point that Shogato is also making.
Yeah, also given that inflation has been comfortable, there is some monetary policy space, so all three levers can be used, but clearly structural policies have to be
emphasis
used.
has to be on structural reforms, not the monetary fiscal levers that are being discussed here. Ajit.
He said both, by the way.
No, he started with structural
He said little bit of fiscal, little bit of that. You allowed him both. But anyway,
okay, moderator's word is final. He said structural reforms.
India's ease of doing business has jumped from 142 to 63, jump of 79 ranks. So we are doing fantastic on reform, right?
Absolutely.
I mean,
We'll take a poll on that. Huh?
last 10 minutes I have said so many things about reform. So first, I'm not sure how finance minister can control reforms. I think finance minister is all about budget making, and so
okay, how your prime minister?
Now we are talking. No, I agree with the reforms. I think there is the fiscal stuff will get. If you are asking me what's your priority, it should be reform.
So left of center is reforms, right of center is push out the levers to start with. Okay, so we'll discuss a bit on the fiscal space a little bit, because she did make this point that, compared to emerging markets, we're already stretched quite a bit and there's not much of room. There's also a sense of, let's say, a cloud of discomfort and a trust deficit, let me put it that way, around what our real fiscal deficit numbers are. Can I do a quick audience poll for those of you who are still awake? So 3.4% of GDP was the stated fiscal deficit number for the center the last fiscal year, FY19. I think there's broad agreement that actually the numbers could be slightly higher than that, but let's start with either the number is right, which is it is 3.4%, or it's off by 0.3%, so 0 to 0.3%, 0.3 to 0.6%, greater than 0.6%. Okay? So bang on right, 0 to 0.3, 0.3 to 0.6, greater than 0.6. Bang on right? You can participate as well, by the way, panelists. 0 to 0.3, 1, 2, 3, 4, 5, 6, 7. Okay. 0.3 to 0.6, 0.6 and above. By the way, I think the number is more than 1% of GDP higher, the real number. But that's me.
Big question for the audience.
So we have, when you 4:45 you said, no?
Yeah.
4:40. Don't worry about that. So big question which we were discussing, in fact, before we got in here. Is it time for us to debate the possibility of an Indian version of MMT, where we say, let's blow up the fisc and monetize the deficit? By the way, we're already doing it. We already have large OMOs, purchases, bond purchases ongoing. We already have huge transfers of surplus that the RBI is doing to the government. If you ask me, it's effectively monetization of the deficit. While to an old guy who's lost hair over the years like me, it sounds like a sinful thing to do. Maybe this time is different. Maybe this time is different. So is it the time to actually unclog our minds of the past and start using fiscal and monetary levers, given all the things that Ajit mentioned earlier, which is inflation is okay, fiscal deficit is fine, external sector is okay, current account is fine. Shogato.
I mean, this is markets. I mean, can't mess with markets. I mean, with so one thing. I mean, so splurge on the fiscal deficit. So you just, 3 days back, got a ratings downgrade for outlook downgrade for a country whose fisc is better than us. Imagine that. Second, this is the fun part of economics, right? This is the fun part of economics. It's all like a balloon. You poke something in here, something out opens out here. So what is likely to open out here? The currency, the exchange rate. The moment, spreads. Right now, the 10-year benchmark over the GSEC, over the repo rate is 135 basis points, which is where we started in January. It had come down to about 35 basis points, opened out again. So, I mean, if you do that, obviously there will be a sell-off. And if there's a sell-off, the rupee will go for a toss. Credit in the first half of this year was 1/10 of the amount of credit that happened in Q1, or H1 of last year. Almost the entire amount of the credit, half that amount, came in from foreign flows. Where do you think foreign flows are going to go if there's a possibility of a currency depreciating? There's this whole story of let the currency depreciate, we'll do exports better and things. This is fine. I don't believe that. But on the other side, I mean, the imports, the debt, and the others, I mean, so it's a complicated story. I mean, you cannot splurge. I mean, you have to find revenues.
So you're kind of echoing my views, but anybody wants to have a different view here? Ajit, you're a radical guy. You want to go? Nothing.
No, I meant.
Everybody here is conservative. Okay, fine. So I like that. Let's go to the next piece then, which is kind of the elephant in the room, which we don't talk about enough, which is the health of the financial services ecosystem. One of the things before we go into growth and coming back is the system in a position right now to fund growth at all or investments at all, particularly NBFCs and trust deficit you mentioned, Mridul, a couple of times. Do you see a solution arising for the trust deficit around, for instance, NBFCs are supposed to have 6.6% gross NPAs as of 31st March. I don't think any analyst worth her salt believes that number. Do you see this trust deficit being sorted out? Do you see the issues in the financial services ecosystem being sorted out? Reforms on financial services ecosystem, is it on the anvil, you think, in Delhi? Anybody?
Well, I think if you there are some issues which are very very difficult to resolve right now, looks like. But I would be a little positive on the financial sector, because I think if you look at some of the things that are being done, I think that's going to make the banking sector stronger, I would say. I think not only you are trying to clean up the banking sector, you're trying to bring in more transparency, but also improve credit culture. So I mean, you might be moving towards a system where loans from the money borrowed from the bank, which corporates borrow from the bank, is treated like loans and not like grants.
Right.
And I think so that's a very positive drift that is playing out underneath all this noise that we are seeing. And then second, I think, is that corporates are also, some of them, promoters are worried about losing their companies. I mean, when did this happen? So these are positive things which will gradually play out and make the financial sector more resilient. That's currently, I think, the problem for the regulator is to ensure that while you clean up, some financial companies might burn, but the fire doesn't spread to the rest. I think so. I think that you have to manage. So there will be some stress. You can't avoid it, and cost of financial sector stress or cleaning up is lower growth. You have to live with that. Right. I don't think you can clean it up and also have high growth. I don't think that's likely.
So a slightly positive view out here that it's not going to be the end of the world.
No, I don't think so. I mean, and I think that even the corporates, they are deleveraging, but they are. The debt equity ratios for the corporates that we rate, I think, has improved. So, and I think the tax cut is going to help them delever further, because the savings so they are going to be primed up for investments once the opportunity arises. So there are some positive signs which are emerging. I think it's the negativity is so strong that those are not visible right now. They're behind the cloud.
Right. Mridul?
I think DK has spoken for me in many respects. So I would just add.
So we won't have a
going on the right. I cannot guarantee anything on this. See, the way the system is, what is very important to see is that we continue pressing the accelerator on sort of necessary financial discipline. So if we have to pay some growth sacrifice, we are paying for that, yes. But what is very, very important to understand is that in the process, reforms are already beginning to work. Take, for instance, the NBFCs. I mean, you virtually had no rating differentials before the ILFS collapse. Virtually 95% of the CP paper was rated AAA.
Yeah.
Today, yes, there have been downgrades which has created worry, but that's the essential reform that was needed.
Yeah.
Markets have begun to differentiate between good and bad NBFCs. I know of NBFCs which have been able to borrow lately at 6%. I know of NBFCs which have borrowed at 16%. I mean, is this really bad? I mean, is it not the way to go forward to? So we need to be patient, and see. And trust the regulator. We are watching the situation very, very closely, monitoring almost 100 top NBFCs on a very high frequency basis through the credit database, through the money market database and stuff. So let us see things improving over a period of time, and I think we should be able to cross the bridge.
Okay. So, quick one word from each of you. Let me rephrase this question. Do you think the issues in the financial services ecosystem can be solved by giving it time, or do you think some intervention of some kind from Delhi, RBI, all put together is required for us to come back onto an even keel? So, is it only a question of waiting it out, or is it somebody has to intervene before a bad bank, a TARP, or whatever you call it, before things get better? Just a quick word. Ajit?
No, instinctively I'm against TARP because TARP is essentially fiscal policy. Actually it is fiscal policy without Parliament support, without Parliament's permission. So I'm not supportive of buying NBFC paper, for example.
Sure.
And yesterday there was an NBFC which did a QIP for 4,000 rupees, like almost 1 lakh crore they raised.
Yeah.
So in the NBFC space, there are some guys who are doing fantastic well. It's a very large space. I think things are getting sorted out, like Mridul also said. Unfortunately, some of the bad apples are going to be really, on the spotlight, and some who have done badly business-wise also will have to figure out a way, but not by an artificial support with TARP-like.
So I think your point is that even if they were to fail, a few bad apples for bad governance,
It's going to happen.
whatever,
Yeah, it's going to happen.
it will not cause it will not be a too big to fail kind of an issue.
Remember, the NPA ratio of the banking sector is already improving. Yeah. I believe the March number was better. Next March is going to be even better. So
questionable, but yeah,
it's in the right direction at least.
it's in the right direction.
And one more point:
Yeah.
the biggest company in the country is saying that I'm going to be zero net debt by next 2 years from now or next year.
We've heard that before, haven't we?
So,
Mridul, do you think any intervention required, or is it just a question of time?
So it's not that policy-wise interventions are not being made. I mean, there's a lot that has been done for the NBFC sector. Only thing what has not been done is to create a moral hazard by sort of bailing out particular firms, particular sector-specific lending, but practically through affording system liquidity as well as special Volcker provisions for the sector,
Yeah.
and also bringing them on a more even keel with other sectors in terms of other regulatory norms. I think this is the right way to go, and that has brought some benefits to the good NBFCs, and we need to go ahead in that direction.
Fair enough. No intervention required?
Well, I think confidence enhancing measures might be needed. I mean, if you see some big guy collapsing, I mean, you need to ensure, it's just like avoid the fire spreading, I mean, so which is basically checking measures to check contagion. I mean, that I don't think that's going to happen, but I think the regulator probably is already vigilant, and I think that's what you need to ensure when you are letting the system clean itself.
Shogata, you've been very quiet.
No, I have my views on this. I mean, probably not a good idea to talk when the cameras are on.
you want TARP?
Huh?
You want TARP?
No, look, I mean, I don't think it's going to be a financial instability issue. Yeah. It depends on how badly do you want growth. How badly do you want credit to fuel this growth? Yeah. I mean, because I have a feeling that this risk aversion that you are seeing is likely to persist for some time. Because, I mean, there's a significant amount of uncertainty. Now, what do you do? I mean, do you do an AQR type measure, a qualitative view? I'm very skeptical about that. Because unless you have a very clean resolution path, just getting an AQR in place is likely to create more demand for capital, more and other problems. So, how do you sequence this? The confidence building measures is very, very important. So, I think aside from the banking system, we should go all out to get FDI. So now, because FDI is a measure to deleverage the system, to do a whole bunch of things. I mean, I think so from that equity part, we need to bring in foreign equity to sort of dampen down some of the concerns on the debt side of the problem.
We have 7 minutes left, and I know Ajit has to run after that. We can take a couple of questions from the audience in case you have any.
Yeah.
If you can give a mic there. In the meantime, one question quickly. Ajit, and we were discussing this earlier. We saw a dichotomy even here between what the audience thinks about economy versus where they think the markets, right? How do you guys explain this dichotomy between bullish mood in the markets and bearish mood in the economy? Are we in a new space where fundamentals don't matter?
Look, markets are always forward-looking, and when Mridul gives another rate cut, I mean, that's what the markets are betting on. I mean, so that's something which is. But I mean, obviously, I mean, the bullish mood in the market, if you break it down, I mean, we were discussing this, is not my insight. No, it's a very, you said that. I mean, it's a very small number of stocks that are doing well. And incidentally, there are a very small number of companies which are actually doing well. I mean, so in this atmosphere. So I think that's part of the explanation.
Okay. Yes, you have a question.
Very good afternoon, everyone. It was an interesting session, sir. And my question is regarding the FDI. I totally agree with all of you that Government of India should focus on more FDI for the revamping of the existing financial.
Closer.
Speak loudly, please. Can't hear you.
I totally agree that foreign direct investments and more of leveraging of that can be of good resort for existing financial challenges. Considering the last 5 years foreign direct investment into India, for example, in the calendar year 2014, India attracted $23 billion US dollars. In the calendar year 2015 and 16, India was the topmost destination for FDI with attracting $63 billion each of the year. Whereas in 2017, the FDI attraction into India fell down drastically to $25 billion. So there is no sustained attraction of FDI into our country.
So first, I don't quite agree with your numbers, and maybe other people have different numbers. The number we should look at is net FDI, which RBI website gives very clearly.
Okay.
The number you mentioned, $60+ billion, that's gross FDI, that's not net FDI. Net FDI, from what I recollect, was about $35 billion in FY17, $30 billion in FY18, $30 billion in FY19. This year until August, I think it's about $19 billion. So it's actually higher than the $13-14 billion it was same period last year. So it seems to be higher. But as DK was mentioning, it seems to be going towards services rather than manufacturing. But what is your broad question? That there is no
sustenance of FDI. The source of information is from Financial Times, sir. The information which I refer
That's
to
the gross.
So, I mean, if I can just, I mean, as a, not from an FDI perspective, this I heard yesterday, learnt yesterday. So, I mean, from a fairly respected private equity investor. So, the quality of Indian entrepreneurs is apparently improving significantly. In the finance, it was already pretty good. Now there are more entrepreneurs, quality entrepreneurs. In other sectors, it's moving up. Capital availability, which is part of that FDI, the PE money that comes in, is actually higher. Culture is changing. I mean, because Indians, the young Indians are becoming more risk-taking. So, I mean, so all of that. Tech has permeated throughout now. I mean, so from direct retail, I mean, 50 million people at least are now being touched by the online retail stores. So all of this, so in now for a consumer goods company to go from a 0 to 200 crore revenue would take about 5 years. Previously, it used to take 25 years. So, I mean, this is the environment that the positive move, I'm finishing on the positive move. So, there's a positive move of the environment that we are moving in. This is highly accretive of FDI.
Okay, thank you. Any other questions? Yes, ma'am. Could you speak up a bit, please, if you don't mind?
Okay, so I know that currently the RBI is struggling a little bit with Kerala's entire concept of masala bonds that have come up very recently, and it seems to be inspiring other states and is trying to be quelled to the best of the ability by the RBI and the government. Now, the government ends up underestimating how much they do allot for disaster relief management, and even what is allotted is always in relief and not for mitigation. Would you gentlemen agree that in the 2020 budget, the government should allocate more towards disaster relief management mitigation to reduce uncertainty in the Indian markets?
I heard RBI and masala bond is related Kerala issue, so I'm going to give it to you.
So I thought there was a mix of questions here, but in essence, yes, masala bond, it's not that RBI is negative on it. I mean, we have just removed the arbitrage which was occurring between masala bonds and the other routes of ECB and put it on a more stable footing, the regime. So it's not that the masala bonds are not being now floated. There is going to be further moves for local currency bond development. There's going to be sort of rupee raising elsewhere. So hallmark of, and I see Mr. Khan here who has suggested a whole lot of debt market reforms. RBI has implemented quite a lot of them. So I think
not implemented quite a lot of them as well.
a few of them. So I won't. The other part about disaster relief, there is this as part of the G20 agenda, and I'm sure more closer attention can be given by government on this. But is it necessary that you have various other ways of drawing the funds in case of a contingency, then actually making necessary provision each year? But it's a deeper question to look at what is the best way to provide for disaster recovery.
I think what you meant was more for mitigating the risk and less for, or rather instead of relief. So disaster relief versus disaster mitigation. Yeah, of course, I think you need to have more money to sort of prevent you rather than post relief. But there's always a challenge because the budget is anyway always you're struggling with so many competing priorities. And there is a national disaster relief fund which goes to states who are declared as disaster areas. And I think you're referring to Kerala floods. So I don't know why you related Kerala floods to the masala bond. I don't know if you're implying that the masala bond money goes to disaster mitigation.
Kerala state, they had a structure they are about to tap the
No, I know that, but she was connecting disaster relief with, or you think masala is a disaster? That maybe. But no, I think always mitigation is better than relief.
entire money is going for infra funding.
Infra as in disaster mitigation. Prevent.
They have a plan of
spending around 50,000 crore on infra development.
Okay.
Is a matter of boosting the economy, and this is going to be funded out of domestic as well as foreign resources. This masala bond has come exclusively for infrastructure. Infrastructure.
Any other questions? Yes.
Can I slip in a question?
Okay, we've
But
got
just one point, I think the masala bond was a bad idea, the Kerala state masala bond, but that's a separate
one more panel discussion. Topic.
Yeah, not sure I heard enough on the question of reviving the capex cycle from the panel. In fact, Dr. Ranate said that we are consumption centric, but if the capex cycle is out for a decade, then it is bound to impinge on consumption, because after all, what is yesterday's greenfield is tomorrow's brownfield, the next day's jobs, the next day's wage traction. So, if anything, we are hearing things on the contradictory. NHAI funds being curtailed, etc., etc. The government has been trying to revive the capex cycle, but not gone anywhere. So, any fresh thinking from the panel on what we do about GFCF formation? Thank you.
So during the high growth phase, the incremental growth rate on private sector capex was almost 20%, and which has gone down to zero, if not negative. So that's the seriousness of the problem. And some of it is getting addressed in the sense that when these distressed assets are going into IBC, they're getting bought out and sort of rejuvenated by somebody else. So change of ownership, but that you can see is unlocking of capex. So I guess in this cycle, fresh capex is welcome, but that's going to depend a lot on various things, including business optimism. But don't ignore the effect of the rejuvenation through the distressed asset route. So there is that revival of capital is also happening through that route to some extent. So that is early signs. That's, I think, a positive sign.
I'll quickly add to this the question that you asked. I think it's a very good question. It's a minority view, but my own little view is that India consumes when we are investing. We don't consume in isolation. When you see growth around you, when you see a company expanding, when you see a company hiring, when you see headhunters calling you up and saying, do you want to join somebody, that's when you start consuming. So it's a very paradoxical situation where no company, by the way, which is getting a tax rebate right now is going to invest because capacity utilization is quite low. So at a time when capacity utilization is low, we want an investment cycle to start, which is where I guess maybe the room for government shifting of expenditures into what the economic survey says, which is education, water management, ports, roads, infrastructure may be required before we actually get the investment cycle.
Anand, that's public sector, the ports road. But for example, I'll give you an example from our company. When we bought the JP Cement business, so that was a locked asset. That was dead in the sense it was now when you buy it for some 13,000-14,000 crores, how to count the 30,000 crores? Is it fresh capex or is it?
It's not fresh.
So I think this is like it plays the role of fresh capex, although it's just buying those.
That would be change of hands, no?
No, I know, but this is that much money is unlocked from the banking system. That is like capex.
Yeah, true, very true.
So
one thing also you need to look at is that the
Capex is
capacity utilization
addition of capacity on ground here.
is still not at
It's
a
not
level
buying
where
it.
you would have the investment cycle. kick in.
Absolutely.
So it may take a wee bit more time, and this is probably the cost we are paying for the earlier overinvestment prior to the global financial crisis, where there was a massive kind of financial closures and sort of embedded valuations for the stock were given just on capex considerations. So clearly, with excess investment earlier, and also economy has liberalized since then, so capacities abroad play a significant role, and there has been excess capacities elsewhere globally, which actually substitute the investment which would have otherwise come domestically. So the cycle has to play out. I think what is important is we should try to lower the user cost of capital, and that's where policy action has been there in terms of lowering the kind of taxes and stuff. Probably we need to think some ways of incentivizing investments, but then given the stress fiscal situation, how much that can be done has to be seen.
I think to a large extent what Shogato mentioned comes true then, the fact that FDI can be the agent for actually bringing in investments into the country.
Yeah, I mean, I hear all of this. What was a bit alarming to me was that with 10 years of the capex cycle being out, capacity utilization, as you said, sir, slid from 76 to 73, rather than move anywhere to that Lakshman Rekha of 80, which is kind of, scary. I mean, your investment cycle is out for 10 years. Yeah. You are trying to stimulate consumption, and yet capacity utilization, if anything, is sliding back. I'm talking about the RBI OBICA survey. So.
Fair point, and that's the point I'm saying that, see, you have to make your industries more competitive, but just by protection, you can't push up the...
Okay, we're completely out of time, and NSE is going to throw us out very soon.
Do we need another MCQ of when would we actually reach this Lakshman Rekha of 80%? 1 year?
Let's do that. I mean, this is your premises, by the way.
Or should we change the metric? I mean, what is it are we looking in capacity utilization? When would we, how did we essentially manage this capacity? And how did we get it so wrong in terms of, as a country, that we are not able to reach high capacity utilization levels despite having decent consumption growth? I take DK's point that, consumption growth is variable, it will come back, but we never seem to be reaching that 80% number at all.
So what we are not. So it depends on, I think, see, the OBICA survey is manufacturing, by the way. And when we talk of consumption, it includes services and a lot of things. So you need to see what's happening to manufacturing, production, and consumption. So maybe I think that's not, we're consuming more services these days, I guess, I think, at a faster rate than the manufacturing products.
I'll also add, so while the data you're giving, Tirthankar, is absolutely right, our per capita income in real terms is still $2,000, right? We are still a completely underemployed, under-consuming population. I don't worry about the demand side too much, to be honest. Again, I'm in a minority. I think the demand will come as long as you have jobs, as long as you have investments coming through. But again, it's a topic for a discussion by itself. I'm sorry, we are totally out of time for questions. Ajit is going to kill me anyway. Chai, we can congregate for any other questions that you have. But thank you very much, all of you panelists. We've been a fantastic panel.
Thanks, Anand, for
really appreciate this. Yeah.
Before I let everyone go, we have a quick 1-minute presentation from Dr. Louis Brower on what IMF does in India. Just 1 minute, and then we'll have to thank you guys. So please stay there. Right. Louis, please.
Hi. Actually, I don't think I'm going to disappoint anybody because I don't have a presentation. I just wanted to thank the NSE and the panelists for hosting this talk by my colleague Anne-Marie. Basically, as you may know, the fund does 3 things. We lend money to governments that are in external stress. We provide technical cooperation on very sort of narrow issues like tax collection, supervision of banks, fiscal policy, and so forth. And we have a policy dialogue with member countries. And as an input to that policy dialogue, the fund spends a lot of time doing analytical work, trying to understand the big trends in the world economy, in the regional economy, in the national economies. And Anne-Marie's presentation today and Manuela's presentation yesterday at Brookings India and Delhi summarize some of that analytical work that supports our policy dialogue with countries. And in the case of India, the Article 4 consultation, the annual consultation of Indian policies will take place at the Executive Board of the IMF on November 25th. And hopefully we will be able to, with the authorities' permission, publish that report. So in the next few weeks, you will be able to read both the assessment of economic policies, the recommendations of IMF staff, and the specific analytical work that went behind that particular exercise. So again, thank you very much for being here. Thank you very much to the panelists. We've learned a lot about the Indian economy today. I hope you did too. We have a very distinguished group of leaders and practitioners of the Indian economy with us. And thanks Tirthankar and the NSE for having hosted our talk today.
Pleasure. Thank you, Luis. So, gentlemen, to thank you, I call upon HR Khan sir. He is ex-Deputy Governor RBI, but he is also Chairman of NSE Clearing, so he is family. So, thank you, sir. Yeah. Yes, please. So, Shogata first. No, I have an order. We'll have to go by what I say, please.
I am overruling you. He has to go early.
Okay. All right, sir. No, no. Get Ajit first, please. No, it's DK. So please. Who's next? This is Ajit. Finally. Mridul next, please. And last but not the least, Anand, thank you. Thank you for excellent moderation, sir. Yeah, I suppose. Luis, please. Thanks, folks. Tea outside. Thank you.
मैन्युफैक्चरिंग सेक्टर का ना बहुत इम्पोर्ट हो रहा है, कंजम्पशन में जा रहा है, those are imports, so अभी we are trying to do something. If we come out with some conclusive